Hi, I'm Juan Manuel Herrera, currency strategist at Scotiabank. The Canadian dollar exchange rate is commonly thought to follow changes in global oil prices, and that is true to a certain degree, but there are a set of important factors that also impact the currency that don't gather as much attention. Looking at Canadian dollar performance since the mid-90s, there are four fundamental factors that combined explain about 95% of the total variation of the dollar. Oil and non-energy prices, the spread between Canadian and US short-term bond yields, Canada's labor productivity relative to the US, and finally, a measure of market volatility. Canada is a net exporter of both crude oil and other basic commodities such as lumber, grains, or metals to the US. When the price of these goods increases, it means that the cost to US consumers also increases. Since they purchase some of these goods from Canada, there is an increase in demand for Canadian dollars, which leads to depreciation of the greenback. Higher oil prices also mean an improved outlook for the Canadian energy industry, which increases the appeal of investing in Canada for foreign investors, which drives demand for Canadian dollars. Next comes the spread between Canadian and US short-term interest rates. Government of Canada and US Treasury bonds are considered risk-free financial instruments, that is, with no significant risk of default. So an investor looking for a risk-free asset to invest in will take the one with the highest return, all else equal. When the interest paid on Canadian debt exceeds that of the US, it increases demand for Canadian bills and bonds, and thus leads to an appreciation of the Canadian dollar. Labor productivity impacts the exchange rate because as Canadian workers are able to produce more compared to US workers, it increases the relative supply of goods produced in Canada against the US. Because Canada is a smaller economy, it cannot absorb all this excess relative supply, which means that the Canadian dollar has to weaken in order for these goods to become attractive for purchase to the US. Finally, bouts of market volatility are associated with an increase in global financial risks or concerns for global growth. In these situations, global investors tend to flock to so-called safe haven assets, which provide better protection against unexpected shocks. An increase in market volatility increases demand for the US dollar against the Canadian dollar, which weakens the latter. However, we found that market volatility has had a much more significant impact on the Canadian dollar since the election of President Trump. Tariffs on Canadian goods and those imposed on China and a number of other countries have increased global political and economic uncertainty, which has bid up the value of the greenback. Trump-related uncertainty has led to a semi-permanent depreciation of the Canadian dollar. All else equal, we estimate that if market volatility had remained constant at its pre-election levels, the value of the Canadian dollar would be around 5% higher than it is today. You can find more thought-leading content from Scotiabank on our website, and you can also follow us on Twitter as well as LinkedIn. I'm Juan Manuel Herrera, thanks for watching.